Come to the next question, number 13. The fund has invested in treasury bill of the face value of rupees 1 lakh each, amounting to rupees 90 crore. If the average annualized yield calculated based on 85 days as on 31st March 2018 was 8.76%, then what was the amount of average purchase price? So you have learned the formula of yield. Do you remember the formula of yield? Yield is equal to face value minus issue price or purchase price divided by issue price into 365 divided by n into 100. 8.76. Just try this. 1 lakh minus issue price upon issue price into 365 divided by 85 into 100. $98,000. So 98,000 is right. If you look at the suggested answer also at the end of this chapter and the end of this case study, it is 98,000. Is it right? 98,000, you got it? Okay. So answer you can see in the book, but this is how you solve it. We have done this exercise earlier also. Now the next question number 14 is, what will be the risk appetite of an investor in this type of product? What will be the preference of the investor in such a product? So what do you think? Low risk? Because it's a debt oriented scheme. So the risk appetite of the investor in such product will be low. Okay. He is risk averse. Therefore, the preference of the investor in such a product is to earn a steady income for a long period of time with minimum risk. Is this understandable? Next is, why is there a fractional amount in the number of units column in the mutual fund product? Why is there a fractional amount in the number of units? If you look at the balance sheet, is the balance sheet giving you number of units in fraction? Yes, 0.59, 0.117. First of all, mutual funds are allowed to issue units in fraction. Then the number of units equal to the amount divided by NAV. And the amount divided by NAV can give rise to a fraction situation. It cannot always be a whole number. So therefore it is possible that there can be units which have been issued in fractions. Okay. Next question or alternative answer. There is a fractional amount in the number of unit column in mutual fund because when the value of the securities changes, NAV of the units are not always in whole number. Therefore, when we divide the amount received by the NAV, sometimes we can get the amount in fraction. Very simple, but you should know it. Small investor can also benefit because the mutual fund can issue up to 4 digits after decimal units. In India, units can be issued in decimals. Shares cannot be issued in decimals. Now case study part 2. This is easier. Answer the following as directed along with reasons. Part B. The type of entity for mutual fund is. Now this is MCQ. It seems it is an MCQ problem. So choose the right answer. Mutual fund is a private limited, public limited, partnership firm or LLP or none of the above. None of the above. Why? Because mutual fund is a trust and is therefore regulated by the Indian Trust Act. So it is neither partnership nor company. D is the correct answer. Try one more. The investment by a mutual funds are controlled by. No, wait. Read fully. SEBI, RBI, registrar of company, both RBI and SEBI. Think and answer. There is no harm in thinking. 1 mark is at stake. There is a money market mutual fund scheme. Who governs money market mutual fund scheme? RBI. No, but there is a money market mutual fund also, no? That is regulated by RBI. So the answer will be Haji D. This was a difficult question. Even I thought initially SEBI. RBI regulates mutual fund investment in the money market investment outside the country. Plus, what is the RBI role? If you are making investment outside the country, then also RBI rules come. Investment from people other than residents in India and remittances inward and outward of foreign currency. Other transactions are regulated by SEBI. So money market investment, and whenever outside countries parties are involved, okay, we have discussed international fund, offshore fund, then RBI's approval or whatever regulations are there will be applied. Next example, next MCQ. When the holder of a units of a mutual fund can sell his unit at any time during the year, the fund is an equity fund, bond fund, balanced fund. Nothing can be said about the classification of the fund from the saleability. What is the answer? Because it can be any of the above. Is it right? So the answer is nothing can be said. All three funds can be bought and sold. Option A, B, C are about the investment made by the mutual fund. Saleability is based on whether it is an open-ended or a exchange traded fund. Now try this one. Following is not true in the context of a mutual fund's payment to its unit holder. A scheme that invests in equity pays dividend. An exchange traded funds pay dividend. A bond fund pays interest. A GSEC fund pays dividend. Which of this is not true? 3 statements are true. Think about this point. See, a bond fund pays interest. Even a bond fund pays dividend. Mutual funds pay dividend to their unit holders. Okay. So to confuse you, they have written bond funds. Whether they invest in equity or bond doesn't matter. Next question. Under SIP, the following is not true. So SIP discussed today. Unit holders can invest on a monthly basis whatever amount they can save. Whatever amount. You are an article, 300 rupees, invest. 900, invest. No. Investor can invest only a pre-specified amount every period, say monthly, quarterly or half yearly. Seems to be correct. If an investor has subscribed rupees 3000 in quarterly payments for a 3-year SIP, he can choose to step up this amount to rupees 4000 from the second year. Can he do that? Even where the SIP amount in a financial year does not exceed rupees 50,000, an investor cannot invest in cash. You have to issue post-dated check or ECS. So which you think is the wrong answer, wrong statement? First one. It seems the first is a wrong statement. Whatever amount they can save. Somebody will come with 10 rupees only. This month I have saved 10 rupees. Can he do that? No. The amount is not variable from months to months. An investor in a mutual fund who wants liquidity within a period shorter than the closure date. Investor in a mutual fund wants liquidity within a period shorter than the closure date should invest in. That means he wants very short liquidity. So where he should invest? He can invest in open-ended scheme, liquid fund also you can write, or exchange traded fund. Open-ended liquid fund scheme you can write. Open-ended mutual money market mutual fund scheme you can write. Next is guild funds have risk. So lower risk, or interest rate risk, or list risk, or nil risk. These are the answer institute has given. You can write interest rate risk is there, but risk is lower, risk is least, risk is nil. An investor who does not want to incur a high expense ratio can opt for one is debt fund, second is also direct plan. What is a direct plan? Again, your institute note has not mentioned about direct plan. Direct plan, when the investor himself invests, he does not take the help of a advisor. That is direct plan. An investor invests himself. He does not take the advice of an advisor. It's called direct plan. Because in that case, the mutual fund does not charge you any cost at the beginning. Okay. Debt fund has a lower expense ratio as we discussed. Last question I think now, or there are some more. Is the standard measure of performance for investor in mutual fund for 1 year or more time period? What is the standard measure of performance for investor in mutual funds for 1 year or more time period? So there is a concept called CAGR, compounded annual growth rate. How much compounded annual rate of return the mutual fund has generated is a measure of performance for investor in mutual fund. Now next question is there any difference between a mutual fund and a scheme? Is there a difference between a mutual fund and a scheme? Suppose there is an HDFC mutual fund which is a trust and they have schemes under that. So it has equity fund, debt fund, balance fund, liquid fund, like this. Okay, so scheme is issued, a scheme of investment made by the mutual fund. It's a subset of a mutual fund. Mutual fund is the entity which is registered as a trust. They issue the schemes. So the term fund and scheme are used interchangeably in the common parlance. However, they are different. Mutual fund is a trust and this is the entity that has many schemes. Example, equity, debt, balance, growth fund. There are many schemes operated by the mutual fund. For example, LIC mutual fund is in the business, is a business entity. You can write the example, any example, and registered as a trust, whereas LIC mutual fund, debt fund, LIC mutual fund, GSEC fund are schemes within the same entity. Each scheme would have a different manager who is known as a fund manager. An NAV is computed for each scheme individually based on the investment out of the scheme funds. We don't calculate the NAV for the mutual fund. We calculate the NAV for the scheme. Okay, scheme related expenses, income, etc. For every scheme this calculation is done. NAV, income, expense. Each scheme is a product that mutual fund has to offer. Each scheme is a product that mutual fund has to offer. So it is like, suppose you are a Maruti Suzuki Limited and you are selling Alto, Wagon-R, Nexa or Hexa? Nexa. These are the product you are selling. So you are a mutual fund, LIC mutual fund, and these schemes are your product. Investor according to their liking would invest in those schemes. In the scheme has names like debt fund, equity fund, exchange traded fund. What we actually mean scheme performance when we talk of the fund performance in the common usage. Funds don't perform, schemes perform. Okay. Then alternative answer you read as homework. Scheme is a broader term while fund is a narrower term. Next question, how is a benchmark chosen for effective comparison of the performance of each type of mutual fund product? Now your study note does not contain the answer of this question. But mutual funds normally what they do? They select a benchmark so that investor can compare. And they will try to select a benchmark which reflect the performance of their schemes. Like equity oriented schemes, they may use Sensex or they may use separate index for mid cap funds, separate index for small cap, separate index for banks. Similarly, there are benchmarks for debt securities also. So that can be chosen. So benchmark is chosen for comparison on the basis of the nature or type of securities, a major portion invested by the fund house. For example, in case of equity linked product, you can use equity index as a benchmark, Sensex or Nifty. For debt funds, you can use yield curve as a benchmark. Alternative answer also you can write, whichever one you find it easy. When a scheme is issued, it is decided in advance where the scheme would invest its funds, whether across companies within a sector or in debt instrument or fully diversified. Accordingly, a benchmark is chosen to represent the appropriate mix of the investment. Benchmark should reflect your scheme. Diversified equity investment use Nifty 50 or S&P BSE Sensex. Mid-cap funds use mid-cap index. Banking sector use bank indices like S&P, BSE, BankX, etc. Yeah, Nifty Bank. Can a mutual fund invest in another mutual fund? Fund of funds. Explain the underlying concept and laws. So the answer is first, yes, a mutual fund can invest in another mutual fund. It is called fund of funds. And what is the relevant law here? Mutual fund can invest up to 5% of its net asset value in another mutual fund, keeping in line with its objective. So again, this you'll find in SEBI guideline. Whenever such questions come, you can either search in this chapter or SEBI guidelines, which is given in chapter number 16. For example, a debt fund cannot invest in any other equity fund, even within 5% level. So if you are a debt fund, you have to invest in another mutual fund, which is also a debt fund, even though you have to invest only 5%. It has to also align, it has to only align its investment in a fund that has a similar objective. However, in the case of fund of funds, this 5% does not apply, since this fund of fund does not have a portfolio of debt securities, but its portfolio consists of units of other mutual funds which invest in debt securities. So this is your legal provision. Can a real estate investment mutual fund invest in residential house property? Then it can invest in commercial real estate asset only. That was a 50-mark question which almost took 1 hour for discussion, maybe little more. You should write in the same sequence. Preferably, you should write the answer in the same sequence. You can keep some space blank and then you can write. but that is not a compulsory condition. Most of them are interlinked, so I think the questions are also set accordingly. So we'll take one more case study too, you'll get some more idea. Okay, so now this question is also appearing in one of the modern model test paper. It has, I think, 3 or 4 parts. First part is very interesting. The following data in table from serial number 1 to serial number 6 is given to you relating to open-ended schemes. Underline open-ended scheme of mutual fund is related to open-ended scheme of mutual fund. So one thing they have made it clear that these schemes are open-ended scheme. It is possible that there may be some contradictory entries or violation of applicable regulation. So they have given you a table below and there are some information which is wrong in that table. You are required to read the information carefully and point out any 6 contradictory entries. Now this really requires an expertise in this mutual fund industry. Okay. State the regulation violated, my God, and give the acceptable data and reason justifying your answer. Not everything is wrong there. For example, entry load is given in the first and second scheme, which we discussed in the previous case study, that SEBI has banned entry load. Yes or no? So that is one mistake I have identified. Similarly, you have to identify where are the mistakes, which regulation is violated and what is the correct position. The name of the funds can be assumed to be correctly stated. So what you have to assume? The header is correct. Otherwise some student in the exam will write equity oriented fund should have been named only as equity fund. Mistake number 2. Exchange traded Sensex 50 fund should have been named exchange fund only. So assume the heading is correct. Okay. So what we will do, we will go line by line. 1, 2, 3, 4, 5, 6. Probably in every line there will be some mistake. Okay. So see, there are 5 schemes given to you. Equity oriented fund means this is going to invest mostly in equities. Exchange traded Sensex 50 fund. So this is ETF which is tracking Sensex. Wait, this is liquid fund. That means mostly they'll invest in liquid investments like money market investment, cash and bank, etc. GSEC fund means mostly they will invest in government securities and monthly income plan. So again this is like a debt plan only, monthly income plan, MIP. So which benchmark they are tracking? Equity oriented fund, can it track BSE Sensex? ETF Sensex 50 fund, can it track the Nifty? Arey, you are a BSE Sensex fund and you are tracking Nifty. So this seems to be wrong entry here. Then liquid fund can track CRISIL liquid fund index. GSEC fund S&P BSE India 10-year composite bond index. And monthly income plan CRISIL hybrid 85 plus 15 conservative index. If something is very complicated, assume it is correct. They will give you such question which the student can easily understand. Of course, this you may not have heard of also, that such index exists also in the country. Is it right? But this was so simple. This is Sensex and this is Nifty. So 1 mark you will get it from this. It is called S&P BSE Sensex. Maybe they have written a mistake, but BSE Sensex, this is not a serious error. Don't worry. Why you are just looking at this? You should also look at this, no? So now they call all the index, many index as S&P BSE Sensex, S&P BSE NSE Nifty. But Sensex is written here, that is enough. Now this is the easiest of the lot. Entry load 2, 1, nil, nil, nil. These two are wrong. As per the present SEBI guideline, entry load is not allowed. Then exit load. Now you have to tell me where exit load is not charged. There is one scheme where exit load is not charged. Which one? In liquid funds, there is no exit load. See the answer at the end of your case study. There is a Roman 4 figure. It's written serial number 3. There should not be any exit load for exchange fund. See the very intention to trade, even this is wrong. Exchange traded fund. Very intention to trade on the exchange is at exit anytime. Similarly, liquid funds carry a lower return only to offer liquidity at all times. Hence, a punishment levy for exit is inappropriate. For the other funds, it is up to the scheme to levy what is marketable and what is dictated by the competition. The SEBI ceiling on exit load wherever applicable is 7% of NAV. In practice, we find that 1% is the outer limit that is dictated by the competition. So there are two errors, but you can mark at least one of them. Liquid funds do not charge an exit load. Exchange traded fund also do not charge the exit load. Now, my dear student, you answer. This is another easy one. Plan type: regular, regular, direct, direct oblique regular, direct oblique regular. What is regular? When you are purchasing through an advisor, and direct means when you are investing directly. Two mistakes are there. You are always allowed to invest directly in any fund now. You are allowed to invest directly in any fund now. SEBI says you can't make it mandatory that an investor has to go through the advisor. Okay, so read the answer number 5 in your book. In column number 1 and 3, both direct and regular should be available. Okay, direct and regular should be there in 1, 2, 3. This one, sorry. Here only direct is written. It should have regular also. Here only regular is written. It should be direct also. Direct means that investor does not have to necessarily go through a distributor of mutual fund, thereby saving on his cost. But for this, the investor must be knowledgeable on the mutual fund market. Okay. Moreover, many investors prefer to pay the small fees which will help them to get advice from the distributor, who must be qualified with NISM certification on his minimum level of knowledge of the mutual fund market. You can also appear in this exam after the CA final and you will get a certificate, and then you can become a mutual fund advisor. Okay, in an exchange traded fund, the demat holding is compulsory, and hence the investor can and has to route it through the broker. So why they have written only regular? Because if it is a demat account, it has to be through a broker. That is why. However, the SEBI has laid down that the direct plan has to be made available to an investor, and he has to have the option of incurring or not the cost of the distributor. So equity oriented fund should have a direct option also. Liquid fund should have a regular option also. Sorry, one more. Investment period. Now again, this is a simple. You can guess it right. Where is wrong? Investment period. You can invest in equity share for a longer period. You can invest in, that means the mutual fund house for 3 years. But do they need to invest in liquid fund for 15 months? Then what is the point in liquid fund? Liquid funds investments are for a very short period. So I will read the answer from your book, point number 6. Can you see that? Liquid fund has a span of 15 months. This is not appropriate. Liquid funds have to provide liquidity as if they are lying in a saving account of a bank, where in the period short and uncertain they will fetch a better return. The investor also does not expect any great income as income, but would in no case tolerate erosion of principal. Hence 1 year is a long for blocking the funds. Moreover, the investments are in money market with very short term maturity, and hence the fund should not expect investors to wait for a year. The ideal period should be 61 days or thereabout. Okay. That is what they have invested in that fund. You can't force the investor to wait for 6 years. That means average maturity of their investment is 6 years. For government security? No. That is for liquid fund. For government, if you invest in a government bond which has a longer maturity, it is possible. Although they can trade in that. Okay. Okay, try one more. Investment of funds. Now this is again very interesting. Equity oriented fund will invest 70% in equity and 30% in its debt. Seems to be right or wrong? $65 and above they can invest in equity. Seems to be right. Exchange traded fund, read carefully, 80% Sensex 30 top 5 stocks. The scheme name is Sensex 50 fund, and they are investing in out of 30 only top 5 stocks. If you are trying to represent or track Sensex and there are 30 shares in Sensex, do you know that? And you are only investing in 5 of them. Will it correctly represent the movement of Sensex? No. And 20% in government security. So this seems to be a wrong idea. And liquid funds are okay. 23 in certificate of deposit, 72% in commercial paper, 2% in treasury bill, 3% in FD. GSEC 83 in government bond, treasury bill 70%. Okay. Monthly income plan 12% in government bonds, 73% in corporate debt, and 15% in cash and receivable. Where do you think is error? Exchange traded fund. Come to your answer. I will read. Sensex 30 index has to be replicated. Is it written there? Investment should be in the same proportion as the Sensex 30 stock capitalization value in the exchange index, so that the average index performance of Sensex 30 is more or less replicated, but for the expense ratio by the scheme. Hence, being a passively managed scheme, the scheme manager has to act once in a while to set right the balance in the portfolio of investment to align it in proportion of the Nifty 50 stock values. Oh, this should be Sensex 30. Sensex 30. Hence, the expense ratio of such a fund also tends to be low. No amount is to be invested in government security under the scheme, since the returns are more important. So at least you can write. They have said find out any 6 mistakes. There are many more, like here there are 2 mistakes. One is they have invested in only 5 stocks. Second, they have invested in government securities also, which index funds don't do. Now part 2. Okay, quickly you will answer which statement is right or wrong. The key features of SEBI Infrastructure Investment Trust Regulation, keep that page open, has been given in the following paragraph. You are required to point out the mistakes and correct it whenever required. Okay, very interesting question. This you can answer in the exam from open book. Infrastructure is defined by Ministry of Finance via its notification dated 07 October 2013 and shall include any amendment. True or false? True. Good. InvIT shall be set up as a trust and registered with SEBI. It shall have parties such as trustee, sponsor, investment manager and project manager. The trustee of an InvIT need not be underlined, a SEBI registered debenture trustee. True or false? This part of the answer is, statement is false. SEBI registered debenture can only act as a trustee. Third one, quickly, InvIT shall invest in infrastructure project either directly or through SPV. Now investment through holding company is allowed. True or false? True. Go ahead. An InvIT shall hold or propose to hold controlling interest and more than 40% of the equity share capital. Underline 40% in your question. Or interest in the underlying SPV except where the same is not possible because of a regulatory requirement emanating from the concession agreement. In such cases, sponsor shall enter into an agreement with the InvIT to ensure that no decision taken by sponsor, including voting decisions with respect to SPV, are against the interest of the InvIT, its unit holders. This statement is right everywhere except that 40 should have been 50%. Okay, one more chance. Sponsors of InvIT shall collectively hold not less than 15% of the total unit of InvIT on post-issue basis for a period of at least 3 years, except for the cases where a regulatory requirement or concession agreement require the sponsor to hold a certain minimum percentage in the underlying SPV. Now there is no limit on the number of sponsor. True. Go ahead. This is true. The proposed holding of an InvIT in an underlying asset shall not be less than 500 crore and the offer size of InvIT shall not be less than 250 crore at the time of initial offer of unit. True, right? True. The aggregate consolidated borrowing of InvIT and underlying SPV shall never exceed 49% of the value of the InvIT asset. Further, for any borrowing exceeding 25%, credit rating and unit holder approval is required. Again, true. An InvIT which proposes to invest at least 80% of the value of the asset in the completed and revenue generating infrastructure shall raise funds only through public issue of unit, have a minimum 35% public float. Is it 35% in your book or 25? And shall have at least 25 investors. How many investors are written in your notes? 20 investors. Have minimum subscription size and trading lot of rupees 10 lakh and rupees 5 lakh respectively. Is this right? What is wrong here? 35% should be 25% and 20 investors. Distribute not less than 90% of the net distributable cash flow subject to loss, etc. on a half yearly basis. True? True. Through a valuer undertake a full valuation on a yearly basis and update the same on a half yearly basis and declare NAV within 15 days from the date of such valuation or updation. True. True false question we are playing. A publicly offered InvIT may invest the remaining 20% in under construction infrastructure project and other permissible investment as defined in the regulation. However, the investment in under construction infrastructure project shall not be more than 10% of the value of the asset. An InvIT which proposes to invest more than 10% of the value of the asset in under construction infrastructure project shall raise fund through private placement, etc. Have a minimum investment and trading lot of rupees 10 crore. Is it 10 crore? That 10 can change your life. Okay, 0. Not that Shah Rukh Khan wala 0. Exam wala. Have minimum of 5 investors with each holding not more than 25%. I think this is right. Distribute not less than 90% of the net distributable cash flow subject to applicable loss to the investor at least on a yearly basis. Is it right? Say yes. Undertake full valuation on yearly basis and declare NAV within 15 days of such valuation. This is also right. Condition for InvITs investing in under construction project. For PPP project has achieved completion of at least 50% and certified by independent engineer or expended not less than 50% of total capital cost. True? True. For a non-PPP project, the infrastructure project has received all the requisite approval and certificate for commencement. True or false? Again true. Listing shall be mandatory for both publicly offered and privately placed InvIT, and InvIT shall make continuous disclosure. True or false? Again true. So there were 4 statements which were false. Is it right? So we'll complete it fast. Come to case study part 2. What is solution we have done? Part 2 is over. So this way you have to solve. Now part 3 is simple. There are some numerical problem which you will do as homework. Okay. Part 3 is numerical. The expected return on exchange traded fund of ABC Limited is 14%. Risk-free rate is 6.5%. Market return is 15%. Compute beta. Use the equation RF plus beta into RM minus RF is equal to expected return. After solving that, you will get the answer like this. 0.85 they are showing approximately. This is a problem from portfolio management chapter. Yes or no? Will be able to solve? Do it as homework. Check the answer. Later. 5 portfolios experience the following result during a 7-year period. Remember yesterday you have done a similar problem. A, B, C, D, E, return, standard deviation, correlation. And I took a similar problem in the class. And then market return, standard deviation of market, risk-free return is given. Compute Sharp, Trainer, Jensen's alpha and rank. Done. Homework. Answer is printed. You can check it. Okay. Where it has gone? Part 4, last part, MCQ. Ready, steady. Suppose that during a short period, very interesting question, very difficult also. Don't read the answer. First you think, say 2 days, there is no change in the investment held in the portfolio of a mutual fund scheme. And there is no change in the number of units outstanding. The NAV per unit of the scheme. Same investment continues, means you have invested in suppose shares of Reliance, shares of Infosys, shares of Tata Motors. Same investment. There is no issue or redemption of unit also. What will happen to the NAV in that case? Increase, decrease or same or fluctuate? So the most appropriate answer is fluctuate, because even though you hold the same portfolio, price of the share will change. If the price changes, NAV can fluctuate. So the answer is tick tick, fluctuate. Okay, next. A invest rupees 10,000 in mutual fund scheme at rupees 10 during the initial fund offer. Okay. B invest rupees 10,000 in another scheme when the NAV was 12.50. Assume that both are growth schemes under the regular plan and both belong to the same investment objective and both have the same fund manager. How does it matter? After 6 months of their investment, the following is true. B's gain is more than A. A's gain is more than B. Both are having equal gains. Nothing can be said of their gains in relation to each other. Vote for D. How many of you vote for D? Unless you know their respective closing NAV, you can't answer, na? Because they are similar schemes, but actually there are two schemes. There are two similar schemes, both may be equity, but you should also know what was the closing NAV. And then only we can say with definite answer that A has gained more or B has gained more, or both are equal. The answer of this question can be nothing can be said unless we know the closing NAV of both the scheme. Third part, mutual fund M equity oriented is listed on stock exchange. Then its units can be sold by an investor through the stock exchange ad. This is very easy. Already discussed 2-3 times. It is an ETF. What is the market price of ETF on any day? It is close to NAV, it's close to face value, or it's close to market value as determined for equity share, or market value at B less brokerage. This is given to confuse you. The correct answer, it will be trading closer to its NAV. Tick mark. So the correct answer was A. One more. Mutual fund is not listed on the stock exchange. Which is not listed on the stock exchange does not have to be bound by the listing obligation prescribed by SEBI. Don't read the answer. Think. Can dictate its own price at which investor will exit or enter the scheme. Will have a low expense ratio compared to the listed mutual fund of a similar type. Does not come within the control of SEBI. Which answer do you think is the most accurate, more appropriate? Does not have to be bound by the listing obligation prescribed by SEBI. Is it right? Because it's not listed. So this is true. Mutual fund cannot dictate its own price. You have to sell at NAV, buy at NAV. And a mutual fund which is not listed will have a lower expense ratio. Not necessary. In fact, it will have a higher expense ratio. And mutual fund which is not listed does not come within the control of SEBI is the worst statement in this list. Every mutual fund except maybe that money market mutual fund come under SEBI. Okay, one more chance. In a mutual fund, the maximum loss that investor has to face is the following. Again, don't read the answer, read and give me the correct answer. A mutual fund maximum loss investor can have. There will be no dividend or bonus unit to add to this investment, and he can at any time pull out with his principal. There will be some dividend issued, but he may lose out more than the dividend when he exits from the unprofitable scheme. Complete investment in the principal can be wiped out without ever receiving any dividend or any gain. And the last is he will not have a notional loss of regretting. He will only have a notional loss of regretting that he did not exit at a better time and reinvest elsewhere. Maximum loss that a mutual fund investor will suffer is point number C. Like for example, you've invested in an equity oriented scheme and the market price of equity shares have crashed where they have invested, which means your NAV will become almost close to zero and you will not receive anything. Okay, so complete investment can be wiped out. Between a growth plan and a dividend plan, today I have dictated or explained to you growth and dividend plan. The following is true for certain mutual fund scheme after the period of distribution of the first dividend. NAV of the growth scheme will be higher than the NAV of dividend plan. Yield in the growth option will be higher than the yield in the dividend option. The yield in the growth option will be lesser than the yield in the dividend option. The yield in the growth option will be lesser than the yield in the dividend option. It seems C and D are same line. Okay, forget the last line. Try in ABC which is the most accurate answer. A, because after the dividend the NAV of a growth scheme will be higher than the NAV of a dividend plan. We can't certainly say about the yield, but we can certainly say about the NAV of growth option after a dividend is declared is going to be higher when an investor buys units of a closed-ended scheme. Closed-ended scheme, the following is true. He has to pay it until the redemption period is specified in the scheme at the time of offer to liquidate his investment. He cannot liquidate his investment at any earlier point in time. This is not right. He has to find a buyer through the scheme manager and sell the units to the buyer if he wishes to liquidate before the redemption period. True or false? You have to tell me whether this line is true or false for a closed-ended scheme. False. You don't have to go to the scheme manager. He can sell the unit before the redemption period through the stock exchange. True. If the fund is not listed on the stock exchange, he can use option B. If it is listed, then he can use B or C. It is listed. Closed-ended schemes are listed. So the best answer out of this lot is C. Okay, try one more. When a mutual fund faces liquidity crunch due to heavy redemption demand, it can borrow in the call market, money market only if it is a GSEC fund. It can borrow in the call money market if it is a GSEC or a debt fund or a gilt fund. It cannot borrow in call money market, whatever is its nature. It cannot borrow in the call money market since it is not a participant at all in the call money market. Now, for this you have to read the regulation, okay? Mutual fund regulation. Which is the right answer? The answer is C. They are not allowed to borrow in the call market, but they can invest. So fourth number statement is wrong. This we have discussed in that money market chapter. Mutual fund can invest but not borrow. Okay. Whatever may be the nature of the mutual fund. And this question we have discussed in money market again. Following is true for a certificate of deposit. This we have discussed. This I have taken also. NRI can subscribe on after tax repatriation basis. NRI can subscribe on a non-repatriable basis. NRI can subscribe without any condition on repatriation, and NRI cannot subscribe to CDs. This is a question from money market. You have forgotten. NRIs can subscribe to CD on a non-repatriable basis, covered in money market chapter. Now, unit of REIT shall be mandatorily listed on a recognized stock exchange, and REIT shall make continuous disclosure in terms of listing agreement. The trading lot for such unit shall be, check in your notes, is it 1 lakh or 2 lakh? 1 lakh, but institute answer is wrong. So I think just check in your notes. They have mentioned B, but it should be A. I'll just check it. Maybe typing error from our staff also. But in the note it is mentioned 1 lakh rupees. This chapter is over. Now we'll continue tomorrow.